Welcome back to Chicago Future of Finance, live from Las Vegas at the Hood Summit. We're talking trading, we're talking markets at all-time highs, a lot of advisor discussion as well. Intercede Neil Azous here, an advisor managing more than $500 million under Rareview Capital, based in Las Vegas. Great to have you here, Neil.
Oliver, good to see you. We go back a long ways.
We do, and it feels like worlds are colliding here. You know, it's trading, it's options, it's the advisor. I think a big theme of this is people did really well during and since basically COVID, trading for the most part. And now it's kind of how do they work that money into a sustainable way where the advisor comes in? How are you thinking about that in your business?
Sure. If you're a financial advisor and you think about options and you just have a starting point that when you sell an option, by definition, you win 3 out of 4 times.
Yeah.
And when you buy an option, you only win 1 out of 4 times. So if you start with that premise and you think about it in a yield enhancement framework, or collecting income, if you will, or what they call buy rights or overrights, there's definitely an advent of that in a portfolio for sure. If it's day-to-day speculation or earnings announcements, I think you have to have a professional approach and know what you're doing. Otherwise, it's a recipe for a challenging time.
Yeah.
But they definitely belong in portfolio construction for sure. And it's incredible to see over the last 4 or 5 years through this organization and others, the proliferation of them and how many people are smart and being involved in it and things like that. It's very different from when I was an options trader, back in the day, 25 years ago. So it's encouraging to see.
There's a wonderful answer. I think the Restream app we use to stream this out, the AI picks clips for the show, I think it's going to pick that response because you really hit a lot there that this show's about, Chicago Future Finance. I mean, it's future finance everywhere, but the Chicago part implies that options, part of it. But then, of course, advisors are everywhere, national in scale, huge amounts of money. And the way you put it, to think about it as the most baseline of thinking about the probability of selling options versus owning options is the starting point. What kind of educational kind of hill do you think advisors still need to climb on average? Do you think there's a lot of education still needs to happen?
I do. So I think of advisors as one cohort. There are day traders or people that are self-directed or learning as a different cohort. They actually tend to learn much quicker than the latter because they're dedicated to it. They're trading it all day. Financial advisors have lots of things on their plate. Options are one of them. So if they're serious about integrating them into portfolio construction, I absolutely recommend 1 or 2 books probably. The names of them are elusive, but I certainly have them on my shelf.
Yeah, probably know some of the guys.
And then secondarily, I think the educational websites at the CBOE, their sister partner peer organizations have great libraries, videos, totally. Education departments. They're wonderful things. And if there are any financial advisor that has a linkage to a large Wall Street bank, they all have education classes, including 1 or 2 weeks in person.
Yeah.
Strongly encourage those to get educated.
Great advice. Great advice. One of the other things that kind of overlaps somewhere with that theme of using options to bolster a portfolio or have something to offer to a younger generation. A lot of this is about succession planning. Where does an advisor money go? How do you appeal to people? You can appeal them through options. You can appeal them through crypto, through alternative asset classes. Last time I saw you was with Matt Tuttle, where you guys were launching BEGS ETF. Right. Do you see that as a vehicle for also kind of augmenting people's strategies, their portfolios?
So in general, if you run a globally diversified portfolio or a multi-asset portfolio, typically about 4 to 6% of it has some bent towards commodities. Okay. In the case of the product that you just referenced, the strategy that we run, that includes both precious metals and digital currencies.
It's Bitcoin, Ethereum, gold, silver.
That's right.
BEGS, BEGS.
That's
up
right.
45% on the year.
It's doing quite well.
Yeah, and because they play off each other very nicely. Bitcoin and gold, I've seen the math on that. And so there's, I would assume, silver and ETH to some extent, but those are pretty new still, right?
The way to think about it is easy. If you're running a global multi-asset or globally diversified portfolio, commodities are a leading instrument this year, led by precious metals and digital currencies. If you want to keep up with a benchmark, you likely have to own some version of that. And then the top 3 or 4 or 5 of those inside the entire world at the moment across all asset classes are the instruments that you just highlighted. Gold, then silver, then Bitcoin and Ethereum. So if you want to be in the race, you got to bet or own the winning horses inside the race. Those are 4 out of the 5 or so. for sure. And I think the real issue is that most people don't have that. Certainly they have a 60-40 portfolio, but multi-asset also includes commodities, credit, and cash. And all assets are melting up, and they're having a substantial outperformance over the traditional industry-dominant portfolios like 60-40. So you definitely need them. I think it will continue. It's nothing to be about, oh, I'm an evangelist for precious metals. I'm a believer. I own them. I think there's a place in portfolios for all of them at the right increments. And you need to have exposure to the horses that are winning.
And again, the math on gold and Bitcoin is pretty good. They oftentimes complement each other. When one is down, if Bitcoin is down, oftentimes gold is solid, and then oftentimes they're up together too. Whereas ETH and silver, I haven't looked at that part, but again, it feels like it's probably analogous to some extent. If you are used to looking at ETFs, you're going to see a fee of 1%, gross total 1.2, right? But is the idea then, hey, this is something that's going to have alpha on top of it that makes up for that?
Yes. So if you're talking specifically about fee structures, right now that's not a dominant conversation in the industry, although always important. Everybody should always read the fine print, understand what the expenses are. But if an industry or an index is up 8, 9, 10%, and those instruments are up 30 or 40%, that's less meaningful right now. But in terms of longer-term financial planning, that's always important. I think when you look at these types of instruments, you probably want to take three things into consideration. One is there are differences between all of these products out there that are 2 times daily reset. You take the risk from 4 p.m. the day before till 9:30 the next morning, and then they have to change or adjust their portfolios with leverage. That has a mathematical impact that leads to significant tracking.
You're talking about the options-driven strategies.
Any 2 times levered product.
2 times levered.
That's borrowing money to get 2 times the exposure, but have to reset it or do a trade every day. The other concept being return stacking, which targets your asset, has significantly or substantially less tracking error if you are looking to use leverage, such as the strategy that we deploy. The second part speaks exactly to what you said a minute ago, which is what they call diversification. How do you get to that? You look at the correlation between Bitcoin and Ethereum, gold and silver, and then you look at those 4 also against the S&P 500. And in both instances, they're very low, meaning digital currencies have very low correlation to precious metals, and both asset classes have low correlation to the S&P 500. That makes it an ideal utility to add into or layer into portfolios for that, meaning one day Bitcoin could go down substantially for whatever the reason is, but gold could stay flat or even appreciate on that day. That's what you're looking for. You want independent positions when you add in different instruments.
To that point, kind of the last thing maybe is, and I'm not, people know I'm not like a crypto evangelist by any means. However, when you look at the correlation point, that correlation did subside a little bit in some key moments this year with stocks. But I think if you still pull back in the history, you're going to see a decent amount, maybe after, let's say, the futures listing of Bitcoin, when it became kind of more deeply liquid, generally have a pretty strong beta tied to the stock market. I wonder if Bitcoin accomplishes the risk part of the portfolio, can a BEGS type strategy that combines these commodities or alts together be a one-stop shop for people? Can they think about it that way?
That's exactly how we think about it, is that you get a one-stop shop all or a basket trade, or if this was a craps table, since we're in Las Vegas, you get the field bet, right? At the same time, you have this reduced correlation between precious metals and digital currencies. And if you're intelligent or thoughtful about how you weight those instruments, meaning gold is 3 times less volatile than ether, and silver is 3 times more volatile than gold. And so if you structure it or volatility weight it, you can have reduced overall contribution to a portfolio, which is what you're looking for. And so, yes, I think that has legs. And I think the easiest way to think about it, Oliver, is that between now and the end of the year or sometime in mid next year, the big custodians like Charles Schwab, Fidelity, they are allowing this to be on their platforms. And there's 100 million accounts that may want to go dip their toe into the water. And that may feel like 10 pounds of bologna going into a 2-pound bag as everybody looks to get some exposure. This is really a simple access product to go do that. You set and forget it. It's thoughtfully weighted, diversified correlation, and a better outperformance than the 2 times daily reset because of the return stack.
Got it. The return stack, the more preferable structure there for keeping your margin. All right, BEGS, 46.6% on the year. Neil, great thoughts on the advisor world, the option stuff too.